Your home just gave you a 27% raise on paper and handed you a bigger tax bill you can't cash. That's the trap fueling today's property tax revolt. We're unpacking why values sprinted ahead of inflation since 2020, how unchanged millage rates still translate into higher bills, and why local budgets pressed by inflation won't blink. Watch to learn the single policy lever economists prefer, levy limits, and why they can curb runaway bills without gutting local services you rely on. If your paycheck crawled up 5%, but your home's assessed value leapt 25%, that raise turned into a bill that bites. You didn't change anything. You didn't add a bedroom or build a pool. Yet the envelope shows a bigger number, and it feels like someone reached into your wallet. The gap between modest income growth and quick jumps in assessed value is where the squeeze starts, and it's not a one-time pinch. It compounds year after year. Take Elena. She teaches 3rd grade, lives on a steady salary, and budgets carefully. Over the last year, her district bumped pay a few percent, enough to cover grocery creep, but not much else. Then her assessment notice landed. The county's new number is a full quarter higher than last year's. She didn't sell. She didn't refinance. Nothing changed except the math that decides what she owes. Cash flow stays the same, but the bill grows. That's the trap. Wealth on paper, thin margins in real life. Since 2020, home prices ran well ahead of paychecks in many areas. Meanwhile, costs for everything from childcare to auto insurance climbed, so the little extra income people did get vanished into daily expenses. Fixed budgets don't flex just because an assessor updates a spreadsheet. When that mismatch hits, it breaks weekend plans first, then savings, and eventually puts pressure on whether you can stay in the same place without cutting something essential. Let's run the numbers. A home assessed at $300,000 last year faces the same tax rate, but now the assessor lists it at $390,000. With the rate unchanged, the base got bigger, so the tax does too. Suppose your local rate is 1.2%. Last year's bill would be $3,600. This year, at $390,000, it's $4,680. That's an extra $1,080 with no rate hike. Meanwhile, your salary went up 5%, and after payroll deductions, premiums, and higher utility costs, the raise is already spoken for. The tax arrives like an automatic subscription you didn't remember signing, only it's larger. Here's the core dynamic. Since 2020, home values have risen far faster than prices in the rest of the economy. When values outpace inflation, the tax base inflates mechanically unless policymakers dial down the rate. The outcome is baked in. If millage doesn't adjust, the math does the work. In other words, the treadmill speeds up, but you're jogging at the same pace. You don't fall because you're lazy. You fall because the belt is moving faster than your legs can keep up. Let's clear up the terms. Assessors estimate market value, but you don't always pay tax on that entire figure. Many places use a taxable value that can be lower, shaped by caps, exemptions, or homestead rules. A homestead exemption might shave a fixed amount off the taxable base for primary residences, while assessment caps can slow how fast taxable value rises each year. Sounds helpful, and it can be, but those protections often have limits, reset at sale, or exclude certain levies. So even with exemptions, a big jump in assessed value often leaks through to your bill. And there's another force at work. Even if the rate holds steady, local budgets respond to higher costs for wages, fuel, and materials. That pressure pushes total revenue needs up, which is why a steady millage on a swelling base still collects more. Blaming the assessor misses that bigger driver. Now the paper gain in your home becomes a real recurring expense. You feel it every escrow payment, every quarter, every year you stay. You haven't cashed out a dime, but you're paying as if you did. Next, let's open the hood on those hidden gears, how millage, levies, and local spending interact, and why your bill can climb even when officials say the rate didn't move. If officials keep saying, "We didn't raise the rate," why did your bill jump anyway? The answer lives in 3 moving parts that rarely show up on the same page. There's the rate, or millage, which is the percentage applied. There's the assessed value, which is the base the math uses. And there's the levy, the total revenue your city, county, and school district aim to collect to fund classrooms, patrol cars, fire stations, and basic services. When those three drift apart, your statement tells the story long before the press release does. Local budgets don't run on slogans. They run on payrolls, fuel, asphalt, and roofs that need replacing. When wages rise, diesel costs more, and construction bids come in higher, the bill for the same level of service climbs. A council can say the rate stayed flat, but if the value of the entire tax base swells, the same millage pulls in more dollars. That's how a community can claim no hike while households still write larger checks. Here's the simple mechanic at work. Property tax equals millage times taxable value. If assessed values jump, a flat rate on that bigger base generates more revenue. Unless officials actively adjust the millage downward to offset the growth, bills rise automatically. It's math, not malice. And it's why you might see a steady rate paired with a levy that creeps up to cover higher operating costs and long-deferred maintenance. Kiplinger has noted that local costs continue to rise. And even as some prices cool, budget needs can keep pushing property tax bills up. The cooling in a few categories doesn't undo a multi-year climb in inputs that cities and school districts buy every day. So the pressure doesn't vanish just because a headline index softened. Let's walk through a city example. Total assessed value across town increases 20% this year as sales reset neighborhood comps. The council leaves the millage unchanged at 1.2%. Last year, a $10 billion base produced a $120 million levy. This year, that base is $12 billion. Without lowering the rate, the levy jumps to $144 million. No vote to hike the rate, yet an extra $24 million flows in. On a median home, the bill moves higher in lockstep because the base did the heavy lifting. Now the policy twist that often gets confused. Assessment limits cap how fast an individual property's taxable value can rise. They can protect long-time owners, but they create uneven bills on identical homes and shift more of the burden to recent buyers and businesses. They also lock people in, since moving can reset the cap and spike the tax. Levy limits work differently. They cap the total revenue that can be collected from existing property, forcing the millage rate down when values surge, so the take doesn't grow faster than the limit. Economic research tends to favor stable, transparent property taxation for growth and accountability. Levy limits align with that by constraining the overall take without twisting market signals or penalizing mobility. They can slow runaway bills while keeping money for core services, especially when paired with clear notices and a public process. That brings us to the practical lever. Levy limits with voter overrides and truth in taxation notices put the choice out in the open. If leaders want to collect more than the cap allows, they can ask voters. If they plan to increase the levy, taxpayers get notice and a hearing. It doesn't forbid higher taxes. It requires a clear decision instead of an unspoken increase triggered by rising values.